Most people who enter trading believe failure comes from lack of strategy, lack of capital, or lack of knowledge. That belief alone already puts them on the wrong side of the statistics. Because the truth is far more uncomfortable. The reason only about 10% make it has very little to do with charts, indicators, or even market conditions. It has everything to do with what happens inside your head before, during, and after every trade. Trading is one of the few professions where your greatest enemy is not the market, but your own perception of it. Two traders can see the exact same chart, the same price levels, the same candle formations, and still execute completely different decisions. One walks away disciplined and consistent. The other spirals into overtrading, revenge trading, and account destruction. The difference is not intelligence. It is bias. Hidden biases operate quietly. They do not announce themselves. They disguise themselves as confidence, intuition, urgency, or logic. And because they feel natural, traders rarely question them. They trust them. They act on them. And over time, these biases systematically push them out of the small group that survives. Most traders never fail dramatically. They bleed slowly. A little overconfidence here. A little fear there. A few rule breaks justified as experience. A few impulsive entries explained away as price action. Over months and years, these small mental distortions compound until the account is no longer sustainable. The market does not need to beat you. You do that yourself. One of the most dangerous biases in trading is the illusion of control. When you first learn a strategy and see it work on historical charts, the brain begins to believe that outcomes are more predictable than they truly are. You start to feel that if you analyze enough, wait long enough, refine enough, you can control the result. But trading is not about control. It is about probability. And the moment you confuse probability with certainty, you begin to overcommit. This bias shows up when traders increase position size after a few wins. It shows up when stop losses are widened because price will come back. It shows up when rules are bent because the setup looks too perfect to fail. In reality, the market does not reward perfection. It rewards consistency under uncertainty. Another silent bias is confirmation bias. This is the tendency to search for information that agrees with your existing belief while ignoring information that contradicts it. In trading, this manifests when a trader decides on a bias first, then looks for reasons to justify it on the chart. Instead of reading price, they interrogate it. You see this when a trader is bullish and suddenly every pullback becomes a discount. Every bearish candle becomes liquidity. Every rejection is ignored. The trader is no longer analyzing the market. They are defending a position that exists only in their mind. And once money is attached to that belief, logic becomes even weaker. The market does not care what you want. It does not care what you need. It does not care what makes sense to you. It moves based on order flow, liquidity, and participation. When you filter that reality through your biases, you stop seeing what is actually happening. Loss aversion is another reason the 90% never escape. Humans feel losses more intensely than gains. A loss hurts roughly twice as much as a win feels good. In trading, this leads to behaviors that are completely irrational but emotionally understandable. Traders cut winners early to lock in pleasure and let losers run to avoid pain. This single bias destroys more equity curves than bad strategies ever could. A trader who cuts winners short and lets losers grow cannot win over time, even with a high win rate. Yet many traders repeat this pattern daily. They move stops to break even too early. They exit at the first sign of profit. But when a trade goes against them, they hesitate. They hope. They negotiate with the market. Hope is not a strategy. It is a bias disguised as patience. There is also the recency bias, where the most recent outcomes dominate decision-making. After a string of losses, traders become overly cautious, skipping valid setups and missing opportunities. After a string of wins, traders become reckless, assuming they are in sync with the market. The market does not know your last trade. It does not know your win streak or your drawdown. Each setup is independent. When you let recent results influence your execution, you are no longer trading the system. You are trading your emotions. Another hidden bias that quietly destroys traders is the need to be right. Many traders attach their identity to their analysis. A losing trade feels like a personal failure, not a statistical outcome. This leads to defensiveness, denial, and revenge trading. When being right becomes more important than being profitable, traders stop following their plan. They add to losing positions. They re-enter impulsively. They hold on to bias long after the market has invalidated it. The account becomes a battleground for ego instead of a tool for execution. Professional traders do not care about being right. They care about managing risk. They understand that losses are part of the business. They do not interpret losses emotionally. They interpret them statistically. Another powerful bias is survivorship bias. Traders look at successful traders on social media and assume those results are typical. They see screenshots of large wins, but never see the thousands of losses that came before them. This creates unrealistic expectations and impatience. When traders believe success should come quickly, they become frustrated when it does not. They system hop. They overtrade. They increase risk prematurely. They abandon consistency in search of speed. And speed is the enemy of mastery. The 10% who make it understand that trading is not a sprint. It is not even a marathon. It is a business that rewards discipline over time. They measure progress in months and years, not days and weeks. There is also the sunk cost fallacy. Traders stick with bad decisions because they have already invested time, money, or emotional energy into them. They hold on to losing trades, losing strategies, or losing habits because admitting failure feels worse than continuing. But the market does not refund sunk costs. Every decision should be based on current conditions, not past investments. The moment you trade to justify the past instead of protect the future, you are no longer rational. Fear of missing out is another bias that quietly pushes traders into low-quality trades. When price moves quickly, the brain interprets it as opportunity escaping. Logic shuts down. Rules disappear. Entries become emotional reactions instead of planned executions. Most bad trades are not bad because the idea was wrong. They are bad because they were taken at the wrong time, for the wrong reason, under emotional pressure. The 10% are not immune to FOMO. They have simply trained themselves not to act on it. Overconfidence is another killer. After some success, traders begin to believe they have figured it out. They reduce preparation. They skip journaling. They increase frequency. They loosen criteria. And slowly, the edge erodes. Confidence should come from process, not results. When confidence comes from outcomes, it becomes fragile. One losing streak is enough to shatter it. Another bias many traders never notice is attribution bias. Traders attribute wins to skill and losses to bad luck. This prevents honest self-assessment. Without honest review, improvement is impossible. Every trade, win or lose, contains information, but only if you are willing to look at it objectively. The market is the ultimate mirror. It reflects back your discipline, your patience, your impulsiveness, your fear, and your greed. You cannot hide from it. You can only grow or be exposed. The reason only about 10% make it is not because the market is rigged against retail traders. It is because most traders are fighting battles they do not even realize they are in. They are trying to outsmart price while being controlled by their own biases. The traders who succeed do not eliminate emotion. They manage it. They build systems that protect them from themselves. They reduce decision fatigue. They standardize execution. They journal relentlessly. They review honestly. They do not look for excitement. They look for repeatability. They do not chase the market. They let it come to them. They do not try to win every trade. They try to execute every trade correctly. The difference between the 90% and the 10% is not intelligence, access, or talent. It is self-awareness. If you do not understand your biases, they will control your trades. If you do not design systems to neutralize them, they will sabotage your edge. And if you do not take responsibility for them, the market will eventually remove you. Trading is not hard because the market is complex. It is hard because humans are inconsistent under pressure. The chart is honest. Your mind is not. But the moment you stop blaming the market and start studying yourself, everything changes. Losses become data. Emotions become signals. Discipline becomes a skill, not a personality trait. The 10% are not special. They are simply willing to do what most are not. They slow down. They reflect. They endure boredom. They accept uncertainty. They protect capital. They understand that survival comes before growth. That consistency comes before scale. That discipline comes before profit. If you are willing to confront your biases instead of feeding them, you are already separating yourself from the crowd. And that is where real trading begins. If this perspective challenged the way you see your own trading, then this channel is built for you. At WealthNest Trade Hub Global, we do not sell shortcuts or illusions. We break down the realities of the financial markets, trader psychology, and capital preservation with honesty and depth. Subscribe, stay disciplined, and remember this: the market does not reward desire. It rewards execution. Trade safe, preserve capital, and grow with intention. What most traders never realize is that biases do not disappear with experience. In fact, experience often strengthens them if it is not paired with reflection. A trader can be active for 5 years and still be operating on the same flawed mental shortcuts they had in their first 6 months. Time in the market does not equal growth. Awareness does. This is why so many traders plateau. They reach a certain level of competence, maybe even profitability for a period, and then everything stalls. They blame the market changing. They blame volatility. They blame news, algorithms, institutions, or manipulation. But rarely do they look inward and ask whether their thinking has become rigid. Rigidity is one of the most underestimated killers in trading. The market is dynamic. Conditions shift. Volatility expands and contracts. Liquidity moves. Participation changes. But biased traders try to force static expectations onto a fluid environment. When the market no longer behaves the way they expect, frustration sets in, and frustration leads to poor decisions. Another bias that quietly operates beneath the surface is anchoring. Traders become anchored to specific prices, entries, or opinions. They fixate on where they entered instead of where price is now. They become attached to a level that once mattered but no longer does. Anchoring is why traders hesitate to exit losing trades. They remember how good the trade looked at entry. They remember how confident they felt. They remember how close price was to profit. Instead of accepting new information, they cling to the past. But the market does not honor past logic. It only responds to current order flow. There is also the bias of false pattern recognition. Humans are wired to see patterns, even where none exist. In trading, this leads to overfitting. Traders see a few coincidental outcomes and assume they have discovered a reliable edge. They add rules. They add filters. They complicate execution. Soon the strategy becomes so specific that it rarely triggers, and when it does, confidence is low. Or worse, it triggers often but fails because the pattern was never statistically valid to begin with. The 10% understand something crucial. Simplicity scales, complexity collapses. They focus on a small set of repeatable behaviors. They trade fewer setups, not more. They reduce variables instead of adding them. This is not because they lack knowledge, but because they respect uncertainty. Another bias that keeps traders stuck is the illusion of progress. Watching videos feels like work. Changing strategies feels like action. Backtesting endlessly feels productive. But none of these matter if execution remains inconsistent. Learning without implementation is procrastination disguised as preparation. Many traders stay busy to avoid confronting the real issue: discipline. Discipline is uncomfortable. It requires saying no to trades that look good but do not meet criteria. It requires accepting boredom. It requires waiting. The market rewards those who can do nothing most of the time. Social comparison bias is another destructive force. Traders constantly compare themselves to others. Someone else's profit becomes a benchmark. Someone else's drawdown becomes a source of fear. This external reference distorts decision-making. Your account size, risk tolerance, schedule, and psychology are unique. Comparing your results to someone else's is meaningless. Yet many traders chase performance that is not aligned with their reality, leading to overexposure and burnout. The 10% measure themselves against their plan, not against other traders. They ask simple but powerful questions. Did I follow my rules? Did I manage risk correctly? Did I execute without hesitation? Did I journal honestly? Profit is a byproduct, not the metric. Another hidden bias is the narrative bias. Traders create stories around price movement. They explain losses with elaborate theories. They justify wins with confidence. These narratives make outcomes feel logical in hindsight, but they rarely improve future decisions. The market does not move because of stories. It moves because of orders. When traders rely on narratives, they lose objectivity. They stop treating trades as independent events and start treating them as chapters in a story. This emotional attachment clouds judgment. There is also the bias of emotional memory. Painful losses are remembered vividly. Smooth wins are forgotten quickly. This skews perception of performance. Traders feel like they are losing more than they actually are, or winning less than they actually are. Without data, memory lies. This is why journaling is non-negotiable for professionals. Not as a motivational exercise, but as a corrective tool. Data replaces emotion. Statistics replace stories. Reality replaces perception. The traders who survive long-term are not the ones with the highest highs. They are the ones with the smallest drawdowns. They understand that staying in the game is the first objective. Bias thrives under pressure. Pressure comes from over-risking. Over-risking comes from impatience. Impatience comes from unrealistic expectations. This is the chain that destroys accounts. The 10% break that chain early. They accept that slow growth is not failure. They accept that missing trades is part of discipline. They accept that flat days are normal. They build systems that assume they will be emotional, distracted, and imperfect. Then they design rules to protect themselves anyway. They reduce decision points. They predefine risk. They automate what can be automated. They ritualize preparation and review. They do not rely on motivation. They rely on structure. Bias is strongest when rules are vague, when criteria are flexible, when execution depends on how you feel. The market punishes ambiguity. Clarity is protection. Every rule you define is a barrier between impulse and action. Every checklist you follow is a filter against bias. Every time you walk away from the screen instead of forcing a trade, you are training discipline. This is why most people never make it. Not because they cannot learn, but because they refuse to slow down enough to unlearn. Unlearning is harder than learning. It requires admitting that some of your instincts are wrong, that some of your habits are harmful, that some of your beliefs are limiting. But the moment you accept that trading is not about being smart, but about being consistent, everything shifts. The market becomes less emotional. Losses become tolerable. Wins become less intoxicating. The equity curve smooths out. You stop trying to impress the market and start respecting it. Only about 10% make it because only about 10% are willing to do this internal work. The rest keep searching for better entries, better indicators, better secrets, while ignoring the one variable that matters most, themselves. If you are still here, still listening, still reflecting, then you are already doing what most traders will not. And that is the real edge. Stay disciplined, preserve capital, and keep building a mindset that can survive long enough to succeed. Welcome to Wealth Nest Trade Hub Global. The uncomfortable truth is that most traders do not lose because they lack opportunity. They lose because they cannot handle opportunity responsibly. Given access to the markets, leverage, and a platform, the average trader is exposed to more decision-making power than they are psychologically prepared for. This imbalance between access and discipline is where biases thrive. Freedom without structure is dangerous in trading. Unlike traditional professions, trading has no boss watching over you, no schedule enforced on you, no penalties for breaking your own rules except the slow erosion of your account. This environment amplifies every mental weakness. Procrastination, impulsiveness, overconfidence, fear, and greed are no longer moderated by external systems. They are left unchecked. This is why self-deception becomes one of the most destructive biases of all. Traders lie to themselves constantly, often without realizing it. They call impulsive trades intuition. They call gambling aggression. They call inconsistency flexibility. They call losses tuition while repeating the same mistakes. Self-deception allows them to avoid responsibility while feeling productive. The market does not care what you call your behavior. It responds only to the behavior itself. Another bias that keeps traders trapped is optimism bias. This is the belief that negative outcomes are less likely to happen to you than to others. Every trader knows about drawdowns, blown accounts, and long losing streaks. But deep down, many believe they will somehow be the exception. This bias encourages excessive risk. It encourages holding through invalidation. It encourages ignoring worst-case scenarios. When the inevitable loss arrives, it feels shocking, even though it was statistically predictable. Professionals assume adversity. Amateurs assume smooth progress. This difference in assumption changes everything. When you expect drawdowns, you plan for them. When you expect setbacks, you size accordingly. When you expect uncertainty, you remain calm under pressure. Another subtle but powerful bias is decision fatigue. Trading requires constant evaluation, especially for active traders. Over time, the quality of decisions deteriorates. Criteria loosen. Patience thins. Small compromises begin to appear. This is why many traders start the day disciplined and end it reckless. The 10% understand that discipline is not infinite. They limit how much they trade. They define trading windows. They step away when conditions are unclear. They conserve mental energy as deliberately as they conserve capital. They know that the best trade is sometimes no trade at all. There is also the bias of control through activity. Many traders feel uncomfortable doing nothing. Flat periods feel unproductive. They equate activity with progress. This leads to overtrading, forcing setups, and entering during low-quality conditions. Stillness feels like failure to the undisciplined mind. But inactivity is often the highest form of discipline in trading. Waiting is a skill. Restraint is a skill. Observation without interference is a skill. Markets move in cycles. Not every moment offers opportunity. The trader who understands this survives longer than the trader who needs constant action. Another rarely discussed bias is emotional attachment to money. Traders who need the money emotionally trade differently from those who do not. When money is tied to survival, validation, or urgency, decision-making becomes distorted. Fear becomes louder. Losses feel heavier. Wins feel insufficient. The market becomes personal. This is why traders are warned not to trade money they cannot afford to lose. Not because losses are guaranteed, but because emotional pressure degrades execution. The 10% build emotional distance from money. They think in percentages, not currency. They focus on process metrics instead of profit targets. They understand that desperation has no place in probabilistic environments. There is also the bias of externalization. When things go wrong, traders blame brokers, spreads, news, manipulation, or algorithms. While these factors exist, overemphasizing them removes agency. If everything is out of your control, improvement becomes impossible. Professional traders focus obsessively on what they can control: risk, timing, execution, and behavior. Everything else is noise. Another critical bias is the belief that intensity equals seriousness. Many traders believe that constant screen time, stress, and emotional engagement mean they are working hard. In reality, this intensity often leads to burnout and poor decisions. Trading is not about intensity. It is about clarity. The most effective traders often look bored. They are calm. They are patient. They wait for alignment. They execute and move on. Emotion is not part of the process. The 10% do not trade to feel something. They trade to execute something. Bias also shows up in how traders define success. Many define success as winning trades, big months, or impressive returns. This short-term focus amplifies emotional swings and encourages risky behavior. Long-term traders define success as rule adherence, drawdown control, and consistency. They measure success by how well they executed under pressure, not by the outcome of a single trade. This shift in definition is subtle but powerful. Another bias that keeps traders stuck is the belief that more information leads to better decisions. Traders overload themselves with indicators, news, opinions, and analysis. This creates confusion, not clarity. Information does not equal insight. Too much input fragments focus and increases doubt. Doubt leads to hesitation. Hesitation leads to missed or poorly executed trades. The 10% simplify. They know exactly what they are looking for and ignore everything else. Their charts are clean. Their rules are clear. Their decisions are deliberate. Bias thrives in chaos. Structure starves it. There is also the emotional bias of regret. Traders regret missed trades more intensely than avoided losses. This leads to chasing price, late entries, and revenge trades. Regret is future-focused pain. It imagines an alternate outcome and punishes you for not choosing it. Professionals accept that missing trades is part of the business. They understand that opportunities are infinite, but capital and focus are not. Another destructive bias is inconsistency disguised as adaptability. Traders constantly tweak rules based on recent performance. They abandon strategies after small drawdowns. They chase what worked last month. Adaptation without data is just emotional reaction. The 10% adapt slowly, deliberately, and based on evidence. They make changes only after sufficient sample size. They respect their edge enough to let it play out. Bias also affects how traders handle winning. Big wins can be as dangerous as big losses. They inflate confidence, loosen rules, and encourage risk-taking. Winning does not mean you were right. It means probability favored you this time. Professionals treat wins and losses the same way. They review them with equal objectivity. They do not let success distract them from discipline. Another bias that quietly damages performance is multitasking. Traders watch multiple markets, timeframes, chats, and social media while trading. This divided attention increases errors and impulsiveness. Focus is an edge. The 10% trade fewer markets, fewer setups, and fewer timeframes. They go deep instead of wide. They understand that mastery requires concentration. The reason only about 10% make it is not because trading is impossible. It is because it demands a level of self-regulation that most people have never been required to develop. Trading exposes who you are under uncertainty. It exposes impatience. It exposes fear. It exposes ego. It exposes discipline. You cannot hide behind excuses for long. The equity curve tells the truth. But this exposure is not a curse. It is an opportunity. Trading can become a tool for personal growth if you let it. It forces accountability. It rewards honesty. It punishes self-deception. The 10% embrace this. They do not fight the mirror. They study it. They understand that every bias identified is a weakness neutralized. Every habit refined is an edge strengthened. Every rule followed is capital preserved. They stop trying to beat the market and start trying to master themselves. And that is why they last. If you commit to this level of introspection, patience, and discipline, the statistics begin to lose their power over you. You are no longer competing with 90% of traders. You are separating from them. This is not about talent. It is about temperament. Not about prediction, but about preparation. Not about speed, but about survival. And if you stay committed to that path, the odds slowly begin to shift in your favor. That is the real truth behind why only about 10% make it. And that truth is available to anyone willing to confront it. One of the least discussed reasons traders fail is that they underestimate how deeply trading conflicts with human nature. The instincts that help you survive in everyday life are the same instincts that sabotage you in the markets. Avoiding pain, seeking certainty, reacting quickly to perceived threats, and chasing immediate rewards are useful traits outside of trading. Inside the market, they are liabilities. The market rewards delayed gratification, not immediate comfort. This internal conflict creates constant tension. Every disciplined decision feels uncomfortable. Every impulsive decision feels relieving in the moment. Over time, traders unconsciously choose relief over discipline, even when they know better. Bias thrives in this gap between knowledge and behavior. Knowing what to do is not the problem. Doing it consistently is. Another hidden bias that quietly controls traders is identity attachment. Many traders tie their sense of self-worth to their performance. A winning day feels like validation. A losing day feels like personal failure. This emotional linkage makes objectivity impossible. When identity is on the line, decision-making becomes defensive. The trader starts protecting ego instead of capital. They avoid stopping out because it feels like admitting weakness. They overtrade to prove competence. They take unnecessary risks to recover confidence. The 10% separate identity from outcome. They understand that trading results do not define them. Execution does. This emotional detachment allows them to follow rules even when it hurts. There is also the bias of selective memory. Traders remember the trades that confirm their beliefs and forget the ones that challenge them. They recall the time they ignored a rule and won, but forget the many times they did the same thing and lost. This distorted memory reinforces bad habits. Without written records, the brain edits history to protect self-image. Journaling is not optional because memory is unreliable. Data is the only honest witness. Another bias that limits growth is the avoidance of discomfort. Reviewing losing trades is uncomfortable. Sitting through drawdowns is uncomfortable. Reducing risk after a setback feels like regression. Many traders avoid these discomforts by distracting themselves with new strategies or market opinions. Avoidance delays mastery. The 10% lean into discomfort deliberately. They review mistakes in detail. They study drawdowns without panic. They reduce size without shame. They understand that discomfort is not danger. It is feedback. Another subtle bias is the belief that discipline should feel natural once you are experienced. When it does not, traders assume something is wrong with them or their system. In reality, discipline never becomes effortless. It becomes practiced. Professionals do not rely on willpower. They rely on routines. Routines reduce decision-making. They standardize behavior. They eliminate negotiation with oneself. When execution is ritualized, bias has fewer entry points. This is why successful traders often appear boring. Their days look repetitive. Their processes rarely change. Their excitement is muted. Consistency replaces thrill. Bias also influences how traders interpret uncertainty. Many see uncertainty as something to eliminate. They search for confirmation, confluence, and validation to feel safe. But uncertainty cannot be eliminated. It can only be managed. The 10% accept uncertainty as the cost of opportunity. They do not wait for perfect clarity. They wait for defined criteria. They do not need to feel confident. They need to be aligned with their rules. Another bias that damages traders is emotional contagion. Being exposed to other traders' opinions, fear, excitement, or frustration can unconsciously alter decision-making. Group chats, comment sections, and social media amplify this effect. What feels like community often becomes noise. Professional traders protect their mental environment. They limit external input during trading hours. They trust their preparation enough to ignore outside influence. Bias also shows up in risk perception. Traders underestimate risk during calm periods and overestimate it after volatility spikes. This leads to inconsistent position sizing and erratic behavior. Risk should be defined before the trade, not adjusted emotionally after entry. The 10% fix risk parameters in advance and follow them regardless of outcome. This removes emotion from one of the most critical decisions in trading. Another deeply rooted bias is impatience disguised as ambition. Wanting progress is healthy. Forcing progress is destructive. Traders rush milestones, scale too early, and increase risk before consistency is proven. Growth without foundation collapses. The 10% move slowly on purpose. They scale only after stability. They protect what they have earned. They understand that capital is harder to regain than to preserve. Bias also affects how traders respond to boredom. Boredom is often interpreted as lack of opportunity. In reality, boredom usually means conditions are not aligned. The market does not owe you action. Professionals are comfortable being bored. They use downtime to review, plan, or step away. They do not manufacture trades to feel productive. Another bias that quietly undermines traders is the belief that discipline means rigidity. Traders think following rules means ignoring context. They swing between being too loose and too strict. True discipline is not rigidity. It is consistency with judgment. The 10% define clear rules, but allow for predefined flexibility. They know when not to trade. They know when conditions invalidate their edge. They adapt within structure, not outside it. Bias also impacts how traders deal with mistakes. Some punish themselves harshly, leading to fear and hesitation. Others dismiss mistakes casually, leading to repetition. Both responses prevent learning. Professionals treat mistakes as data. No drama, no denial. They ask what failed in the process, not what failed in them as a person. The longer a trader stays in the game, the more subtle the biases become. Early mistakes are obvious. Later mistakes are nuanced. They hide in execution details, timing, and risk management. This is why growth never ends. The 10% never assume they are finished learning. They remain students of themselves. They refine behavior as markets evolve. Ultimately, trading success is not about eliminating bias. It is about recognizing it quickly and limiting its impact. Bias will always exist. Emotion will always exist. The difference is whether they control your actions or simply inform your awareness. Only about 10% make it because only about 10% are willing to take full responsibility for their behavior under uncertainty. The rest keep searching for answers outside themselves. But the market has already given you the answer. It is written in every trade you take. The question is whether you are willing to read it honestly. That willingness, more than any strategy or setup, is what separates the few who last from the many who fade away. And that separation begins the moment you stop asking how to beat the market and start asking how to stop beating yourself. At some point in every trader's journey, there is a quiet crossroads that determines whether they will eventually fall into the 90% or slowly separate into the 10. It is not marked by a dramatic loss or a major breakthrough. It usually appears during a long, uneventful stretch of trading where nothing seems to happen. No big wins. No devastating losses. Just repetition. This is where many traders lose interest. The excitement fades. The illusion of fast progress dissolves. And boredom begins to feel like stagnation. Bias whispers that something is missing, that a new strategy is needed, that the market has changed, that progress should feel more exciting than this. But this stage is not stagnation. It is stabilization. The traders who quit here often believe they are falling behind. In reality, they are closer to consistency than they have ever been. But because the emotional highs are gone, they mistake calm for failure. The 10% recognize this phase for what it is, the transition from emotional trading to professional execution. Another bias that quietly surfaces at this stage is the craving for validation. Early in a trader's journey, external praise feels motivating. Likes, comments, screenshots, and recognition reinforce the sense that progress is real. But reliance on validation creates dependency. When validation disappears, confidence weakens. Professional traders learn to validate themselves through process. They do not need applause for discipline. They do not need recognition for patience. They know that most of the work that matters is invisible. Bias also affects how traders interpret time. Many believe that if something is not working quickly, it is not working at all. This short-term time compression leads to premature conclusions and unnecessary changes. Time in trading works differently than in most areas of life. Edges reveal themselves over large samples. Consistency compounds quietly. The absence of immediate results does not mean absence of progress. The 10% understand that patience is not passive. It is active restraint. Another subtle bias is the illusion of readiness. Traders feel ready to scale up because they feel confident, not because the data supports it. Confidence is emotional. Readiness is statistical. Scaling without data turns discipline into hope. Professionals require proof before progression. They define benchmarks. They require consistency across conditions. They scale slowly and deliberately. Bias also shows up in how traders deal with uncertainty during execution. When price hesitates, traders interpret hesitation as danger. They exit early. When price moves smoothly, they interpret it as safety and hold longer. The market does not move to comfort you. Smooth price action can reverse violently. Choppy price action can resolve cleanly. Execution must be rule-based, not comfort-based. Another deeply ingrained bias is the belief that suffering is necessary for success. Traders glorify stress, long hours, and emotional exhaustion as signs of commitment. This leads to burnout and poor decision-making. Struggle is not proof of effectiveness. The 10% optimize for sustainability. They build routines they can maintain. They protect sleep, health, and mental clarity. They understand that longevity is a competitive advantage. Bias also influences how traders react to drawdowns. Some panic and abandon their plan. Others deny reality and increase risk. Both reactions stem from emotional discomfort. Professionals treat drawdowns as expected phases, not emergencies. They reduce size if needed. They review execution. They continue following rules. They do not catastrophize. Another bias that keeps traders trapped is the belief that once profitable, discipline becomes easier. In reality, new challenges emerge at every level. Larger size introduces new emotional pressure. Success introduces complacency. Growth does not remove bias. It reveals new ones. This is why the 10% remain vigilant even after achieving consistency. They do not relax standards. They refine them. Bias also appears in how traders interpret market noise. They react to every movement, every candle, every fluctuation. This hyperreactivity leads to micromanagement and overtrading. Not every movement is information. Professionals know which signals matter and which do not. They wait for confirmation defined by their system, not by emotion. Another bias is the tendency to overvalue analysis and undervalue execution. Traders spend hours refining ideas and minutes executing them poorly. But execution is where money is made or lost. A simple strategy executed flawlessly outperforms a complex strategy executed inconsistently. The 10% focus disproportionately on execution quality. They rehearse it mentally. They review it objectively. They refine it continuously. Bias also affects how traders perceive fairness. Many believe that good behavior should be rewarded quickly. When it is not, frustration sets in. The market does not operate on fairness. It operates on probability. Discipline does not guarantee immediate reward. It guarantees long-term survival. Another subtle bias is the assumption that mistakes should disappear over time. When mistakes reoccur, traders feel discouraged. In reality, mistakes diminish gradually. They never vanish completely. Progress is measured by frequency and impact, not elimination. The 10% do not aim for perfection. They aim for fewer errors, smaller errors, and faster recovery. Bias also shows up in how traders treat their edge. Some overprotect it, becoming fearful and hesitant. Others overexploit it, becoming reckless. Both stem from insecurity. Professionals trust their edge without abusing it. They allow it to play out. They do not interfere unnecessarily. They respect variance. Another overlooked bias is the belief that discipline is a personality trait. Traders think they are either disciplined or not. This fixed mindset prevents growth. Discipline is a skill. Skills can be trained, reinforced, and strengthened, but only if approached deliberately. The 10% train discipline like any other technical skill, through repetition, through feedback, through adjustment. Bias also influences how traders end their days. Many walk away emotionally charged, replaying trades, second-guessing decisions, and carrying stress forward. This erodes clarity over time. Professionals close the day intentionally. They review. They log. They detach. Tomorrow is treated as a separate event. Another bias that quietly erodes performance is the fear of consistency. Some traders subconsciously sabotage stability because chaos feels familiar. Calm feels uncomfortable. Consistency removes drama. Drama feeds emotion. The 10% choose calm even when it feels unfamiliar. They allow stability to replace excitement. Ultimately, trading does not reward brilliance. It rewards alignment. Alignment between rules and behavior, between risk and tolerance, between expectations and reality. Only about 10% make it because only about 10% are willing to align themselves this deeply with the demands of the market. Not for a week, not for a month, but consistently, quietly, and without applause. If you continue down this path, questioning your reactions, refining your process, and respecting uncertainty, you are no longer part of the crowd trying to win. You are part of the minority trying to last. And in trading, lasting is what makes winning possible. What ultimately separates those who last from those who disappear is how they respond when trading becomes ordinary. Not difficult, not painful, just ordinary. The market opens. Setups appear occasionally. Some trades win, some lose. Nothing dramatic happens. For many, this ordinariness feels like failure. They entered trading expecting intensity, constant stimulation, and fast transformation. When reality settles into routine, bias interprets it as stagnation. The mind starts searching for novelty, new markets, new time frames, new strategies, anything to recreate the emotional charge that once felt like progress. But consistency is quiet by nature. The 10% learn to respect the quiet phases. They understand that boredom is not the absence of opportunity, but the absence of compulsion. It is a sign that emotion is no longer driving behavior. Another bias that becomes visible at this stage is outcome fixation. Traders begin measuring their worth by short-term results, even after building a solid process. A red week feels like regression. A green week feels like confirmation. This constant emotional recalibration destabilizes execution. Professionals detach evaluation from short-term outcomes. They assess performance over meaningful samples. They look for patterns in behavior, not fluctuations in equity. Bias also affects how traders interpret effort. Many believe that if they are not working hard, they are not progressing. But trading does not reward effort in the traditional sense. It rewards restraint, selectivity, and timing. Doing less, but doing it better, is counterintuitive. The 10% internalize this. They stop measuring effort by hours spent staring at charts and start measuring it by quality of decisions made. Another subtle bias is the need for closure. Traders want trades to resolve quickly. Extended consolidation creates discomfort. Uncertainty lingers. This leads to premature exits or unnecessary interference. The market does not operate on your timeline. Professionals accept open risk without emotional agitation. They trust predefined parameters. They allow trades to unfold without constant supervision. Bias also shows up in how traders respond to external life stress. Financial pressure, relationships, fatigue, and personal expectations bleed into trading decisions. The chart becomes a proxy for unresolved tension. This is why emotional regulation outside trading matters inside trading. The 10% build stable routines beyond the charts. They manage sleep, stress, and lifestyle. They understand that clarity in trading begins with clarity in life. Another overlooked bias is the belief that confidence must precede action. Traders wait to feel confident before executing. When confidence is absent, they hesitate. Confidence is a result, not a prerequisite. Professionals act according to rules regardless of confidence. Confidence emerges from repeated rule adherence, not from emotional certainty. Bias also affects how traders handle missed opportunities. One missed trade can haunt the mind, leading to forced entries later. This revenge against the market is subtle and often unconscious. Missing trades is inevitable. The 10% accept this fully. They do not chase what is past. They reset quickly and wait for the next opportunity. Another deep-rooted bias is the assumption that more screen time leads to better results. Traders feel productive when they are constantly monitoring price. In reality, this often increases impulsiveness and fatigue. Observation without intention leads to interference. Professionals define when they watch and when they step away. They trust alerts, levels, and preparation. They do not babysit every tick. Bias also influences how traders interpret risk after success. A series of wins creates a false sense of safety. Rules feel restrictive. Risk feels manageable. This is often when discipline slips. Success is a test, not a reward. The 10% treat winning periods with the same caution as losing ones. They maintain size. They maintain rules. They assume variance will return. Another bias that keeps traders inconsistent is emotional storytelling. Traders replay trades mentally, rewriting outcomes, imagining alternative actions. This rumination creates mental noise and erodes presence. Professionals review deliberately, then let go. They extract lessons and move on. The next trade is not burdened by the previous one. Bias also appears in how traders relate to uncertainty itself. Some fight it, some fear it, some try to eliminate it. All of these responses create tension. The 10% coexist with uncertainty. They accept that not knowing is part of the profession. They do not seek certainty. They seek alignment with probability. Another subtle bias is the belief that discipline should feel satisfying. In reality, discipline often feels neutral, sometimes even uncomfortable. Traders mistake this lack of emotional reward as lack of progress. Discipline is not designed to feel good. It is designed to work. Professionals do not need discipline to be emotionally rewarding. They need it to be effective. Bias also affects how traders define freedom. Many enter trading seeking freedom from structure, schedules, and constraints. Ironically, freedom in trading only comes through structure. Without structure, the mind creates chaos. The 10% embrace structure as liberation. Rules reduce anxiety. Plans reduce doubt. Boundaries create clarity. Another bias that surfaces over time is the temptation to loosen standards once consistency is achieved. Traders feel they have earned flexibility. This gradual erosion often leads to relapse. Standards must rise with experience, not fall. Professionals tighten execution as size grows. They respect the compounding effect of small mistakes. Bias also impacts how traders interpret learning. Some believe that once they understand markets conceptually, execution should follow naturally. In reality, understanding and execution are separate skills. Knowing does not equal doing. The 10% train execution deliberately. They rehearse. They simulate. They refine behavior under pressure. Another bias is the tendency to overestimate short-term volatility and underestimate long-term opportunity. Traders react strongly to recent movement while losing sight of broader context. Professionals zoom out when emotion zooms in. They ground themselves in structure, not noise. Bias also affects how traders respond to silence. No trades, no alerts, no action. Silence feels uncomfortable. The mind fills it with doubt. Silence is not a problem. It is often a sign that conditions are not aligned. Professionals respect silence. Ultimately, trading success is not about finding the perfect mindset. It is about building a system that functions even when your mindset is imperfect. The 10% do not rely on being calm, confident, or motivated. They rely on process. They accept that some days they will feel distracted. Some days they will feel emotional. Some days they will feel uncertain. And yet, they execute anyway. Only about 10% make it because only about 10% stop trying to feel like traders and start behaving like professionals. Quietly, repeatedly, without drama. If you can learn to value that kind of consistency, the market stops feeling like an adversary and starts feeling like an environment you understand. Not because you can predict it, but because you can navigate yourself within it. And that is the difference that lasts.